Today we have the SEC patting themselves on the back. Meanwhile, they're telling us everything we already know and gaslighting the public at the same time. They're blaming retail investors for the events, for broker-dealers basically pulling the buy button. And at the same time, they're outing themselves in the GameStop report, proving to us that it's broker-dealers' fault and not the NSCC. They're hiding failures to deliver. And this is something that's been going on for an extended period of time. And I'm also going to show you guys 100 ways that they are hiding short interest. So check this out. Kensler comes out today and says, as the year comes to an end, I want to thank the SEC staff for their hard work overseeing our $120 trillion capital markets. They're giving themselves a good old pat on the back here and breaking down their 6 divisions. I had a really simple question. How do you really serve investors? Stop putting hedge funds over retail. Start by issuing jail time for market manipulation instead of pointing fingers at retail investors just for trying to get ahead. And this has been happening over and over again. Check out this awesome little video that Gary Gensler put out.
We've all come to hear the general story.
Let me crank that volume up a little bit for you guys.
We've all come to hear the general story. A stock that went from 20 to 480 and back to 40, all in a matter of weeks. GameStop, though, was just one of many so-called meme stocks that exhibited significant price volatility, trading volume, and attention in the markets this past January. Our staff at the Securities and Exchange Commission have been assessing the market events of January, and they've just published a report on the developments in the markets, both the equity markets and the options market, with a focus on you, the individual investors. Now, investing in the stock market naturally comes with risk. But the extreme volatility of meme stocks tested the capacity, the resiliency of our markets, and it gave us an opportunity to study how we can further ensure that the markets are working for everyday investors. I think the events lead to a number of areas for study. One, the events that may have caused brokerage firms to restrict trading and what we can do to lower those chances in the future. Two, trading in Darkpools and through wholesalers where it's not going to the stock exchange when you send an order, and the related payment for order flow. Three, the use of predictive data analytics to market to each of us differently through digital engagement practices. And four, short selling and the market dynamics around short selling. If you're interested in getting a deeper understanding of the GameStop events in January, then check out our report that we just published.
To answer your question, this video was published when the SEC put out the GameStop report. And contrary to popular belief, it was not the NSCC or the clearinghouse's idea to restrict trading. NSCC, like most similar central counterparties, does not instruct its member firms to stop trading or clearing individual symbols because its rules do not give it that ability. However, as discussed below, some broker-dealers restricted activities in a limited number of individual stocks in reaction to margin calls and capital charges imposed by the NSCC. This would be a decision made by the broker-dealers and not directed by NSCC. You can see here, in their customer accounts agreements, some broker-dealers reserve the right to decline customer orders or cancel trades without prior notice. Such actions could be taken, for example, for legal, compliance, or risk management reasons. As GameStop and other meme stocks experienced increased levels of volatility, some brokers with a largely individual investor customer base restricted some types of trading by their customers in these stocks. Notice how they said some types of trading, because they didn't restrict your ability to sell. They only restricted your ability to buy. Because, of course, the broker-dealers were colluding with their hedge fund buddies. They wanted you to sell your shares of AMC stock, Gamestop, COS, SLV ETF, the silver ETF. And you can see here, one narrative at the time attributed the broker-dealer trading restrictions to pressure from hedge funds and their commercial partners for the restrictions. This narrative was the subject of testimony at a congressional hearing where witnesses testified that the trading restrictions did not result from such pressure. Instead, some of the impacted broker-dealers maintained that the trading restrictions were a reaction to margin calls and capital charges imposed by NSCC in response to extraordinary volatility in GME and other stocks. However, we know for a fact that that is not true because we have a literal plethora of evidence here in which Vlad Tenev, the CEO of Robinhood, and their team spoke directly to Citadel Securities and a large number of other firms. So even though they claim we don't answer to hedge funds, the reality of the fact is that there were a lot of conversations there between them and their buddies. Robinhood themselves had over a $2.5 billion margin call, as well as many other firms. So as you heard Gary Gensler mention just moments ago,
lead to a number of areas for study. One, the events that may have caused brokerage firms to restrict trading and what we can do to lower those chances in the future. Two,
and of course he didn't say that there was any issue with them restricting trading. They said you're shit out of luck.
Trading in dark pools and through wholesalers where it's not going to the stock exchange when you send an order. And
notice how he said when you trade in dark pools and through wholesalers, like on Robinhood, IBKR, Webull, etc., even Charles Schwab, and even oftentimes through Fidelity, if you're not routing your orders manually, your trading is occurring in dark pools and through wholesalers. And they have the right to take away your ability to buy or sell at any moment. And when that happens, your orders are internalized. They don't actually hit the lit markets. They have a very minimal price impact on the stock. It's a fraction of what it actually should have. And it's all legal. Now we know that the SEC is hiding the missing GameStop failures to deliver data in a FOIA request recently. Now, I didn't get my information from Wall Street Bets. I got my information from the guy who actually did the FOIA request himself. You can see here from FTD FOIA on Superstonk, posted all of the information and links to his FOIA request. And I'll share that with you guys so you can get a good idea of what we're talking about. I'm going to briefly summarize it. I'm not going to read the entire post, but I'll give you the important bits. He submitted a FOIA request, Freedom of Information Act request for information here regarding the Securities Exchange Commission missing information for failures to deliver data for GameStop. The data I requested covers critical dates where GME's FTD numbers were notably absent, dates tied to key market events like at-the-money offerings, share transactions, and margin calls. So he submitted a FOIA request in October to the SEC asking for that between several dates between May and September. And they were especially concerning because the FTD data was either missing or incomplete, raising questions about potential market manipulation or withheld data. Of course, you can see here you mentioned May 24th, the day GameStop completed its first at-the-money offering. While this may have provided enough share liquidity, the absence of FTD data for the day is suspicious. May 30th, the 5,000 share blocks of dog stock, right? Dog stock, for those of you that don't know, is Chewy. You can't say the name of other stocks on Superstonk. So Chewy is the stock he's talking about. When it started trading in dark pools and significant GameStop options activity was observed. We all know that Roaring Kitty took out a large position in Chewy at the time. Now, in the absence of FTD data, raises questions about whether the data was withheld due to high failures to deliver. June 11th and 12th, the GameStop completed its second at-the-money offering during these dates. The absence of the data coinciding with the offering is notable, and he asked for clarification. July 25th, the day after significant events related to Roaring Kitty's large share purchase, with the NSCC failing to settle. Missing FTDs for this day are highly suspicious and, of course, demands explanation, as you guys would agree. July 31st and August 1st, the dates aligning with the NSCC settlement period, right? The T+35 data for Roaring Kitty's additional large share purchases. Again, missing FTD data. August 15th, right? More information, August 20th through 28th. Regarding the margin call cycle, overlap with financial events, September 4th through 13th, nearly 2 weeks of missing FTD data, starting the same day as GameStop's share count, highly irregular, September 20th and 24th, tied to a 60-day period after the NSCC declared a major GameStop share transaction insolvent. The absence of FTD data, again, especially concerning. And if there was nothing to hide, why would they be hiding it? The SEC responded. This letter responds to your request. We have determined to withhold the requested information since it contains confidential commercial or financial information that is protected from release under Exemption 4 or 5 of U.S. subchapters 552b4. Please be advised that we have considered that the foreseeable harm standard in preparing this response. And I agree with him when he says it's kind of ridiculous that the SEC routinely discloses FTD data to the public because it's their fucking job, but seems that they prefer to only freely share benign FTD info, and that the problematic information remains in the shadows. They claim that it could harm financial interests. This, of course, raises a lot of red flags, and if there was an investigation taking place, why would they have released all the other information for FTDs, but not these particular dates? It doesn't add up. The reality of the fact is, these missing data points and their relation to major market-moving events really can only protect one group of people, and it's not retail investors. So this guy did go ahead and file an appeal. He says, I'm appealing the denial of my FOIA. This is recent here, by the way. This was posted here 2 days ago, as you can see. So this is not other requests you guys have seen. I'm appealing the denial of my FOIA requests for GameStop for the reasons of public interest, the foreseeable harm standard. He said the denial fails to explain how disclosing the data would harm any protected interest as required by the FOIA Improvement Act of 2016. And it being an overbroad application, and there's historical precedent, whereas the SEC has previously disclosed similar data, establishing a precedent for its release. Of course, they have not. They acknowledged receipt of my appeal, but have yet to receive a response. And he says, my second FOIA request. We have had one FOIA, yes, but what about second FOIA? I absolutely love this Lord of the Rings reference, which I think you guys do as well. Eternally unsatisfied, I also submitted a second FOIA for the correspondence and records related to the processing of my first. And he goes on to request it, right? And I'm going to skip all this here. And he says, I do not know if they'll be honored. But of course, I think we all know that they won't be, because the Securities Exchange Commission under Gary Gensler here is not out to help retail investors. It's out to help their buddies on Wall Street. And anytime that something happens that shouldn't be happening, of course, there are minor slaps on the wrist, right? That's all that really happens between them. And a small fine, the cost of doing business. Of course, he says there are a multitude of shenanigans suffered upon GameStop, and the same goes for AMC and these other dozen stocks and exchange-traded funds like SLV, costs, etc., that were basically retail was robbed from taking profits on, and you lost your ability to significantly make more money. But the Securities Exchange Commission, even though they know that the brokerages were at fault because you signed the agreement with your firms like Robinhood and Webull, etc., and Schwab, and all the other firms, E-Trade, that removed your ability to buy the stocks, there's nothing you can do about it. So some of these things that you could submit a FOIA request for are the consolidated audit trail errors, the detailed short interest data, options activity and market maker reports, blue sheets, which is never going to happen. They're never going to give us the blue sheets for them either, as you've seen that they're not going to do it for MMTLP or any other stock because they know that there's serious amounts of manipulation, synthetic shares, phantom shares, and so on. And of course, they can't have the public knowing about that. But you can submit information for a large number of these things. This isn't something that's just happening right now. This isn't new to the 2010s or the 20s. You can see here that there's an article here from 1984, almost exactly 40 years ago, in which they were talking about short sellers in Toys R Us. Short sellers in Toys R Us. And this is a digitized article from the New York Times. And here it is on this particular page. You can see here that Lehman Brothers found on their desks the weekly copy of Market Strategy Report. And it was heavily oriented toward technical market analysis. And on page 2 of the report was a recommendation to sell short the shares of Toys R Us. Right? Between the spring of 1980 and autumn of 1984, its shares increased 1,200%, 1,200%. And at the time, of course, 1984, Lehman Brothers was already putting out short and distort FUD campaigns, fear, uncertainty, and doubt, to try to get people to sell and to short sell their Toys R Us stock. Eventually, they succeeded. The difference here between GameStop and AMC and Toys R Us and Blockbuster, for example, is that retail investors didn't evangelize stocks like Toys R Us and Blockbuster. There was no social media like this, right? You couldn't watch other people provide due diligence and information on YouTube and Twitter and Rumble and so on, and Reddit like we can nowadays. So things have changed. The times have changed. I went ahead and asked Grok, hey, how could short interest in a stock be hidden? Explain all the ways you can find in depth. And I'm going to read these to you. Short interest in a stock can be hidden or obscured through several methods, some of which involve exploiting regulatory loopholes or using less transparent financial instruments. Number 1, offshore reporting. We've talked about this on this channel many times. Institutions might move short positions to offshore accounts where they are not required to report these positions to domestic regulatory bodies like FINRA or the SEC. This reduces the reported short interest in the stock since these positions are not accounted for in official reports. Huge shout out to fellow ape, Regarded Ape, because he's absolutely correct. Synthetic shorts. Utilizing options to create synthetic short positions can mask true short interest. For example, selling call options or buying put options, an investor can achieve a similar economic effect to short selling without it appearing as short interest. Ladies and gentlemen, this is called married or divorced puts, married or divorced calls, right? Married options. This involves strategies like selling naked calls, selling call options without owning the underlying stock, which can mimic a short position. Buying puts, purchasing put options gives the holder the right to sell the stock at a specified price, effectively betting on the stock's decline without directly shorting the stock. Algorithmic trading and short laddering. Algorithms can engage in activities like short laddering, also known as ladder attacks by retail investors. These ladder attacks oftentimes are basically wash trades, where traders might artificially depress a stock's price through coordinated buying and selling of the stock at progressively lower prices. This can hide the actual short interest as the trades appear as regular market activity rather than short selling. And for those of you that are unfamiliar with this, high-frequency trading algorithms can easily be programmed by quants in order to buy or sell one stock from one firm to the next, to the next, to the next, over and over, back and forth, many, many hundreds and thousands and even millions of times in order to bring a stock price down. Naked short selling. This is the practice of selling shares without first borrowing them or ensuring they can be borrowed. Naked shorting can inflate the number of shares sold short without it being reflected in short interest data. As these shares might not be reported or accounted for until settlement, this practice is illegal but still occurs due to enforcement challenges. We've recently seen Citadel Securities was recently fined a measly $3 million for over 44 billion misreported shares and trades to the consolidated audit trail. You guys recently saw, I believe just last week, we talked about it, JP Morgan Chase was fined $1 million, a measly $1 million, for misreporting over 71 billion trades. Jeez. That's how astronomical these are. That is a fraction of a fraction of a fraction of a penny. Misreporting data. There can be instances where short interest data is reported incorrectly, intentionally, or due to errors in data aggregation. This might involve underreporting the number of shares sold short or manipulating the data. And continue on. They can use multiple accounts or subsidiaries. They can use options market loopholes. Each of these methods exploits different aspects of the financial system's transparency, leading to a scenario where actual short interest might be higher than what is publicly reported or perceived. This can impact market dynamics, leading to unexpected price movements, especially if these hidden shorts need to be covered during a squeeze. Now, of course, I know there's more. You know there's more. So I said, give me some fucking more. Here's additional methods through which short interest in a stock can be obscured. Failures to deliver. Use of exchange-traded funds. Dark pools and over-the-counter trading. Trading in dark pools or OTC markets can help hide short interest since these trades do not go through public exchanges where data is more transparently reported. Large blocks of shares can be shorted in these opaque venues, keeping the activity away from public scrutiny. Ladies and gentlemen, do you understand why an upcoming stock brokerage like Lit Exchange is so important to you? If you did not, you should now. Go to litexchange.com. The link is over there, right down there in the chat. Click it. Go sign up. It's as easy as entering your email address. And if you really want to do yourself a favor, if you really want to invest in the company and avoid this sort of manipulation, well, you can own a part of Lit Exchange. This is the first time in the history of the world that any upcoming stock and crypto brokerage firm has given you specifically, all of you retail investors, non-accredited investors, the chance to own part of the company via the Jobs Act of 2012. Using Regulation CF, you can use a FINRA-regulated funding portal and broker-dealer called Silicon Prairie to own a part of Lit Exchange. And here in the coming months, we will launch, and in the coming few years, we will IPO. And upon our plans to do so, you will then have an opportunity for a significant exit. Think about that. Instead of going to the first hedge fund we can find, like Robinhood did, for example, with Sequoia Capital, and they raised $3 million. That's how Robinhood started. We're giving you the chance to own Lit Exchange. We could go to Sequoia, we can go to some of these other firms, but that's not what we're all about. We're not trying to go to a hedge fund to raise money, because we're not trying to become beholden to hedge funds. We're beholden to retail investors, because this is the first time that a upcoming stock and crypto brokerage is created for retail investors by retail investors. Swaps and derivatives. Financial instruments like total return swaps and others can be used to gain bearish exposure to a stock without directly shorting it. How do you think Archegos exploded? Why do you think Credit Suisse, the bank, the prime broker, exploded as well? Why do you think UBS is in big trouble? Swaps. Broker-dealers. Some brokers might engage in practices like locating shares for short sales, but not actually ensuring these shares exist or can be obtained, which delays or avoids reporting of the short. This might skirt around Regulation Show, which aims to prevent naked short selling by requiring shares to be located before selling short. The messed up thing is that broker-dealers don't actually have to locate the shares. They just have to have reasonable belief that they can get those shares. So if a firm like FTX that doesn't actually hold any, you guys remember FTX, says, hey, we've got a bunch of, tokenized securities over here that are backed 1-to-1. Of course, we know they're not, and they never were. And Well, then firms like Robinhood and Webull can then lend them out to others, to short sellers, and reduce the cost to borrow artificially and help them short with stock that doesn't exist. Wash trades. Through coordinated trades where no actual change in ownership occurs, traders can artificially manage the appearance of stock volume and price, hiding short interest. Buying and selling in shares among a controlled group to influence market perception without actual market impact. International short selling. Misuse of exemptions and regulations. Layering. And spoofing order books. Of course, these methods highlight the complexity where transparency can sometimes be compromised, leading to a situation where actual short interest might be significantly higher or lower than reported. But wait, that's not all. Give me some more. And look at that. Wouldn't you know, we're on 17 already. 17 different forms of market manipulation to hide short interest. Internalization of orders. Some brokerages might internalize orders. How do they do that? Using payment for order flow. They buy your orders from companies like Schwab and Robinhood and Webull and IBKR. And then companies like Citadel and Virtue, the wholesalers, internalize your trades, matching buy and sell orders within their own system rather than sending them to public exchanges. If these internal trades include short sales, they might not be reported as part of the official short interest figures since they don't hit the public tape. Hence, do you understand why your order is going automatically to lit markets through lit exchanges is so important yet? The use of company shares in employee compensation plans. The manipulation through American depository receipts. The delayed reporting or timing mismatches. And if you want to read any of those without me going through every single one, you can pause the video and go ahead and read them for yourself. The abuse of the easy to borrow list. Stock lending programs with hidden terms. Algorithmic hiding of short signals. Use of non-standard settlement cycles. Are you beginning to understand what we're talking about here? These aren't conspiracy theories. These are facts. These are not bugs. They are features in the financial system, in the stock and crypto markets, meant to fuck retail investors and help out smart money. Exploiting regulatory arbitrage, manipulating market on close orders, specifically market on close orders. Using market on close orders to short sell can influence the closing price, but might not be immediately recognized as short interest if these orders are managed in a way that they don't show up in daily volume or short interest calcs after the fact. Now, wow, that's a lot. Any more? Gee, what's this? Here are a few more. Cross-market manipulation. Traders might use correlated markets or assets to manipulate one stock price perception without directly shorting it. For instance, shorting a related commodity or ETF could indirectly pressure the stock's price without the short interest showing up in stocks reports. Exploiting volatility products like the volatility index, the VIX. Traders can create synthetic short positions in stocks. Manipulating share repurchase programs and stock buybacks. Use of confidential information in short positions. Layering with short selling in mind. Reverse conversion arbitrage. Disguising short interest with long positions in related securities. Use of proprietary trading desks. Manipulating data through misclassification. Wow. We're at 35 already. And I think I could keep asking it over and over and over again and get 100+ different forms of market manipulation. These are just broad spectrum answers here, in the reality of which every single one of these 35 that I've showed you so far has dozens and dozens of forms of manipulation in which each one can be worked in a different manner. I'll just stop here, okay? I think that's enough. I think you get the fucking point, don't you? If you don't get the fucking point, the fact is that every single day, retail investors, whether you know it or not, are getting robbed. Me, you, my kids, my grandma, my mom, your family, your neighbor, the grandma and grandpa, everybody. We're all getting robbed. Our pensions, 401ks, thrift savings plans, IRAs, ISAs, you name it, equities, bonds, crypto, it's all manipulated. I don't care if it's mortgage-backed securities. I don't care if it's credit default swaps. I don't care if it's AMC or Gamestop. It is all being manipulated. The thing is, there's only one way to put a stop to it. I think you understand what that is. The only way is to do it ourselves, because the Securities Exchange Commission's not going to do it. You know that.
Come to hear the general story. A stock that went from 20 to 480 and back to 40, all in a matter of weeks. Gamestop, though, was just one of many so-called meme stocks that exhibited significant price volatility, trading volume, and attention in the markets this past January. Our staff at the Securities and Exchange Commission have been assessing the market events of January, and they've just published a report on the developments in the markets, both the equity markets and the options market, with a focus on you, the individual investors. Now, investing in the stock market naturally comes with risk, but the extreme volatility of meme stocks tested the capacity, the resiliency of our markets, and it gave us an opportunity to study how we can further ensure that the markets are working for everyday investors. I think the events lead to a number of areas for study. One, the events that may have caused brokerage firms to restrict trading and what we can do to lower those chances in the future.
You can see here, there's no problem with broker-dealers pulling the buy button. Gary Gensler went ahead and said it himself. What can we do to lower the chances of this happening? Stopping companies like AMC and GameStop and ETFs like the SLV and COS equities from actually running in a short squeeze. How can we stop short squeezes is pretty much what he's saying.
Two, trading in dark pools and through wholesalers where it's not going to the stock exchange when you send an order, and the related payment for order flow.
I don't have to say this. If you didn't know this, it's coming directly from the chair of the SEC. Payment for order flow should be illegal. It was created by none other than Bernie Madoff, the Ponzi scheme king. And then, of course, along came Ken Griffin after years of saying that payment for order flow shouldn't be allowed. You know, in 2004, he came, he embraced it, figured out a way to make it work for him, and now payment for order flow is his best friend. The same goes for Dougie Sifu of Virtue Financial. Doug Sifu, along with Ken Griffin, prior to 2004, used to be opposed to payment for order flow, saying that it was unfair and didn't help retail and hurt retail investors. Well, you see that both Virtue and Citadel are now making buku bucks off of it. Your orders are being traded in dark pools when they buy them through payment for order flow, allowing them to internalize your orders, front run your trades, buy and sell ahead of you, marry your calls and puts, and really make sure that they've got the upper hand.
Three, the use of predictive data analytics to market to each of us differently through digital engagement practices.
Well, let's go ahead and make sure that we use our high-frequency trading algorithms and short and distort FUD campaigns to market to retail investors and make sure we scare them away from stocks that hurt us.
And four, short selling and the market dynamics around short selling. If you're interested in getting a deeper understanding,
and as I told you guys here in the GameStop report, you know very well that the NSCC, the clearinghouses didn't restrict the trading activities, didn't force the brokerages to do it. The brokerages did it because they lent out shares that they didn't have, and they continue to do that. This is a long-running thing. I've showed you 35 different ways, which in reality is hundreds of different manners when you break down every single one of the ways that each one of these forms of manipulation can actually occur, of just how bad all of these issues were and the way that this short interest is hidden. So when you see 16% short interest, 20% short interest, 30% short interest, the reality is we don't have any idea just how many hundreds of percent it really is, or how many times over the float has actually been sold due to the creation of synthetic shares from the liquidity fairies in Virtue and Citadel and other market-making firms that also have hedge funds that benefit from the artificial creation of shares that don't exist. And they benefit because these companies dilute your shares of stock, and the company doesn't benefit from it. It's one thing if GameStop or AMC does a share offering. They can sell some shares, bring in money for the company, and then secure their future. It's another thing when the market maker does it for the sake of liquidity. Again, this is legal. It is legal for market makers to sell shares of stock they don't own. This is called naked short selling. And they use the market maker exemption rule 203B III in order to do so. So we know exactly how these things work, and they're not going to go away anytime soon. You can see here the margin requirements for GameStop began at 80% and then increased to 100% the following day. First, they reduced the limit of contracts per customer, the trade limit, and then they reduced it even further. And on January 28th, the firm stated they would restrict all new customer purchases in 8 securities: AMC, BlackBerry, Express, GameStop, COS, Naked, and Nokia, and place them in position close only. And this happened over and over and over again. At one point, on January 29th, a lot of you guys don't know this, the firm's list of restricted securities grew to over 50 names. And they were no longer permitting fractional share purchases in restricted securities. What did they do in order to stop this? Well, let's go to my Twitter real quick and look up a company by the name of... what's the name of that broker dealer? The crypto firm. Let's find it. Why don't we? I'm sure it won't be hard to find. Bittrex. Now, they did this for AMC. They did this for GameStop. And I know I've got the screenshots here. FTX did the same thing. Many, many companies have done this. They create securities. Bittrex Global's tokenized stock offerings allow users from around the world to trade 24/7. Their newly listed stocks include GameStop, AMC, BlackBerry, Nokia, SLV. And what date did this occur? January 28th, 2021. Here it is. You can see here the tweet that they put out at exactly noon on January 28th. GameStop is now available on Bittrex. Right. Here you go. Here's from Lit Exchange directly. Lit Exchange LLC posted this. You know what? Let me give that a retweet and a repost. And of course, in case you guys didn't know, Bittrex was working in conjunction with FTX. They says, as part of our product line for eligible customers, Bittrex Global offered tokenized securities, known as tokens, through our historical relationship with Alameda Research, being the arm of FTX. We suspended trading of those products immediately as the news of FTX and Alameda's difficulties hit last week in order to protect our customers. In light of the news since then, we've decided to shut down this product completely. Yeah, the news was that FTX never held a fucking share. Alameda didn't hold a fucking share. They were all synthetic. And Bittrex worked directly with them to do it. Look at these guys. Wonderful. As you can see here, the tokenized stocks value supposedly collateralized by an equivalent amount. They were issued on January 28th, the very same day that all of these firms were placed on position close only in order to create liquidity, in order to be able to give them shares to borrow that didn't really exist. So I think that I will leave this video there for you, ladies and gentlemen. I want to wish you all a happy holidays, happy New Year. I hope everybody had a Merry Christmas. Ladies and gentlemen, make sure you're properly hedged. There are many stocks, many firms out there in which you could invest. some better than others, and some with greater potential than others. If you're jaded on the current offerings with, say, NVIDIA, MicroStrategies, and other firms on the stock market that seem extremely overvalued, you need to look into private equity with Lit Exchange. Quant Trades asks, do you find issue with retail doing algorithm work, not necessarily high-frequency trading, but maybe something more to look for? Well, that's a long question, my friend. I don't have the time to answer that right now. I'll answer that privately. I'll shoot you a message on Discord, buddy. 401 Doge, Al Bundy, Lemon Pie, Felix, Maynard, Hilsey, ladies and gentlemen, Darren. I'm glad to see all of you. Thank you so much for being here with me. I wish you peace and wealth. We're going to be filthy fucking rich. And for me, it's not a question of if, it's a question of when. When. Still holding strong. And with the current prices on GameStop and AMC, for example, and even silver, holy shit, the price of silver as well. I think I might have to buy some more. No problem, bro. It's just a long question, man. It's a complicated answer. Jamie, Queen Bee, ladies and gentlemen, you're the best. Sorry I didn't get a chance. Road Dog says, I'm an owner of Lit Exchange. Cheers, my friend. Yeah, there are hundreds of retail investors already invested in Lit Exchange. And one day, other people are going to wish they had gotten in on the ground floor like you guys did. Especially when we IPO. And they're buying at way higher prices than you're currently able to buy. 401 Doge, I appreciate that help, the comment there about the legal team with FOIA request assistance for that guy. I will definitely put it up in the post. It seems like he seems very experienced in it as well, but I will definitely throw that out there on the Reddit thread for him. Yvonne, great to see you, my friend. Welcome, my dear. Ricardo, Ken, awesome. Ken says this market's being held together with bubblegum. Yeah, you're absolutely right. That's a big part of the reason why I advise everybody to make sure they're properly hedged, because there's more than one way to skin a cat.